Welcome to the daily update, where I'll go over the action in the market for Friday, November 21st, and we'll see how things look for Monday, November 24th. Now, we had a bit of a bounce, less than 1% with the S&P. It was options expiration. We did see above average volume, but it really hasn't changed the bigger picture. Now, on the positive side, we do have some pretty significant support that's still holding, and I'll show you that. We've broken through shorter term support. This is a little bit longer term. And for right now, the market seems to be making a stand above that support. So that's positive. Now we're coming into a holiday shortened week. The market will be closed on Thursday for Thanksgiving, and then it closes early on Friday for Black Friday. So volume may be lighter, especially on Friday, but maybe Monday, Tuesday or so, that might be a little bit heavier, especially if the market goes back to being more under pressure. Because the bigger picture, the really big picture is that we're still positive. The bigger short-term picture is that we're still looking more defensive. In fact, growth really didn't have all that good of a day on Friday. The indexes were up. And there are some folks thinking maybe this is support that we can bounce up off of. We don't know that yet. But when you look under the surface of the market, it's still looking more negative or more defensive than it is positive. Okay, so from now until the end of 2025, I have a thing called the SPX investing program. The videos are available. Just for example, this video will be available uh, early Saturday morning in the US, where it's not available until Sunday morning on YouTube or Rumble. So you get a little bit of a head start there. And you also get immediate access to the weekly videos that I do, where they're delayed on YouTube and Rumble. So if you feel the videos help you out, um, check this out. Also, I'm thinking about this. I might be changing a bit of the format of things once we get into 2026. And I've got some different ideas that I'm thinking about. If any of you have any feedback for how I might do things, not so much with the daily and weekly videos, those are going to still stay the same. What I post on YouTube and Rumble may change a little bit, and I might be doing shorter videos. I tried that a while ago and it worked pretty good. My issue now is just time to be able to put these things together and make them available. So be looking for that on YouTube and Rumble. We'll see what I end up posting on the website. That might end up being a different, because I'm mainly using the YouTube and Rumble videos to tell about the program, where on the website, my total focus is on education because I'm an educator. All right, so let's go back and talk about what happened. We did have a higher open. The futures, it was strange. I was watching them. We were up pretty strong, maybe about 0.5%. Then we went down and actually went negative for a while. Then we came back up and looked a little bit stronger after Europe opened. And so by the time the US market opened, we did end up having a higher open, but then we saw selling immediately. We declined below the unchanged level, but before climbing to the daily pivot. So it was a pretty choppy. We were kind of chopping along sideways. We'd go up a little bit, down a little bit. The daily pivot was at 66.14, so still above that 6600 level. Then we just chopped above and below the daily pivot at 66.14. And this should be briefly climbed to the 6650 level. That set the high on Friday. And then we declined back down below the daily pivot and closed right at the 6600 level. So again, it's a psychological level. It was options expiration. So there's probably a lot of strike prices that were impacted by this. And the more that the psychological level is hit and we end up closing around these levels, the more it becomes a technical level. So we were up 0.98% and we were above average of volume, not a surprise because of options expiration. And as I said, we're still negative in the short and intermediate term. We're positive in the long term. We're not really seeing a shift back to more of an offensive move, at least yet. We'll see if something happens in the upcoming week. We're supposed to be in a period of positive seasonality, but that just hasn't unfolded that way, at least up till this point. Interest rates are not really a big problem now, and we're getting this mishmash of different economic reports. And again, later on, I use two different sources to come up with the economic reports calendar each week. I go to briefing.com, and they had one list of reports that are due out. And then I go to investing.com. I look at their economic calendar, and the two are completely different from each other. So nobody really knows how these economic reports are going to end up coming out. All right, so some comments. There was some Fed speak that was a little bit more positive this time. John Williams from the New York Fed, who is a voting member, helped ignite the rally on Friday. We were just chopping around, not really showing much conviction, and then we broke to the upside. Didn't last for very long, but he came out and said, I still see room for a further adjustment in the near term, which means December in this context, to the target range for the Fed funds rate to move the stance of policy closer to the range of neutral. Okay, he could have just come out and said, I think maybe there's justification to cut rates again in December, and the market liked that. Now, this is the New York Fed president, so that's a very important part of the whole Fed, real big part of it. But this is not the chairperson. This isn't Powell. So we have to take what other folks on the committee say with a little bit less weight than when Powell himself is speaking. And then Boston Fed president, another big important Fed part of the Fed system, who is a voting member, echoed a mildly restrictive policy stance, though her comments had little impact on the market. It's like, well, it's Friday. We want to be happy. Let's at least end the week on a positive note. So, small caps and mid caps, based on what John Williams said earlier, isn't he a composer for movie scores? The small caps and mid caps like that. And of course, every time they have an update, it's like, is this the breakout? Is this what we've been waiting for? We've been waiting for years now, 2023, 24, 25. Well, are we going into 2026? Now we're likely to get some kind of a bounce, especially from the small caps during the Santa Claus rally. They tend to perform well during this time of year, but so does the overall market in November and December. And so far, November's been a disappointment to the markets. And then the equal weight. This is another reason we want the weighted version to perform better. That means that the really big stocks are having more of an impact. They always have an impact, but if they're going up, that has the S&P going up, where the equal weight version treats all stocks the same. And that actually did better than the weighted version in Friday's session. So a little bit more defensive or not as offensive, depending on how your perspective is on that. And growth didn't really, it underperformed value. So a lot of the bounce that we saw on Friday was growth or was value, not growth. And now we have the 100 period moving averages and this lower volume weighted moving average. I'll show you the charts of all of this stuff here. We're still above those levels. We were watching that for Friday's session. And even after Friday's session, that support is still holding. And we're still above 20, though, with the VIX. When we have negative annualized returns, we're at 23.43. It came down from the 26 range to the 23 range, but it's still above 20 overall. And we still have this confirmed Hindenburg-Ullman lurking in the background. And a little bit shorter list, some of our negative short-term indicators are starting to drop off this list, where we still have the CCI 14 and 20. That's been on the list when we were going down. That's still on the list. But the Stoke RSI, the Williams percent R, they're not on the list right now. The stochastics are starting to be extreme, but they pretty much always are. And even with the bounce, we're still far away from the 20 period moving average. Price is under that moving average. And then we're still dealing with the TTM squeeze, which is going down and starting to get extreme negative. Then no change to the overall scenario. I mean, they can come out and say what they want, but it's really what is said at the meeting, which will be, I believe, December 19th. So we still have some weeks out until that actually happens. But the market is pretty much day by day. It was a done deal a couple of weeks ago. They were like 95% that there was going to be a rate cut. Now it kind of vacillates between 50-50 depending on who says something that's on the FOMC. The dollar was down a little bit, which did help stocks. Interest rates were also down. We closed at 4.06% with the 10-year yield. And then we're still extreme negative. Now we improved. We were at 6 after Thursday. We climbed all the way to 11, but that's still way below the 25 level. So we're still looking extreme negative there. And we're still in a negative trend. We really haven't changed much that way. It's negative and strengthening in both the short and intermediate term, and the red line is above the green line still. And with the update, the bias is positive. I'm still keeping the momentum at negative for right now, because it really didn't change all that much. And you'll see what I mean as I go through the charts. So we did get the S&P Global. Now this is a little bit different. This is different than the ISM manufacturing. So I don't show charts with this. What we look at here, just the numbers, whether it's above or below 50. If it's above 50, that shows expansion, but it did decline. Last time we had the report, it was at 52.5. This time it was at 51.9. So it declined, but it's still above 50 overall. Then the services PMI, that actually went up. We saw 54.8 last time. This time it came in at 55. Consumer sentiment, I mean, there's a lot of stress going on right now. People are worried about their jobs, they're worried about debt, they're worried about inflation. Now, the market may not necessarily be worried about those things, but people are. And so we came in at 51, which is a little bit better than the preliminary reading that we had at 50.3. And for some reason, my stock chart didn't update this. So I don't have this chart to show you. Um, the 50.3, that's what we had in the preliminary reading. And then the final reading that we had in October was 53.6. So it's even going down from on a month over month basis, and it's declining year over year as well. We were at 71.8 a year ago. Now we're at 51. So there's a lot of stress going on. People aren't feeling as good about things right now, which is kind of a dangerous thing heading into the big shopping season. So, okay, so here is the consumer sentiment going down in all three ways that we look at this. The blue line is the total reading, and that's declining. How people are feeling right now, that's the purple line, declining there. And then how are people feeling about the future? They rounded out a little bit here, but they're still not as optimistic going forward. Then here's the wholesale inventories, which I didn't have on the other list. This came in just a little bit higher, but down from previous readings that we've been seeing. All right, and then this is a variation of a chart I showed for Friday's video here. This is just showing the real S&P as opposed to the fake one. And then in the recessions are marked in here, whether we're in a bull market or a bear market. This goes all the way back well into the 1800s here, and these are different market cycles. And so, from a time perspective, a case can be made that, okay, we're a little bit beyond halfway, but we look like we were already halfway there before. But you can see this thing doesn't hit always right at the middle of these big arches here. This one hit back here in the 60s, the 40s, going through the 70s here. These are very long term. And we always want to look at the big picture as much as possible just to keep our perspective in the right place. And then stocks rarely peak in October, but sometimes they do here, where a lot of times they end up peaking in December or even into January. And then our baseline assumes broadly favorable conditions. They spelled favorable the UK way here, without incorporating extreme shocks or blue sky. Blue sky, this goes back to older days of the stock market. They have blue sky laws, and each state would have their own individual laws. And if you were like a broker, you would have to register in every state if you wanted to sell somebody stock there. And what you're being told in Florida might be different than what you're hearing in Iowa or something. And then they standardized that later on, and now these rules apply to the whole country itself. But we would say blue sky like a pie in the sky. That's kind of the figure of speech that we use now. That would be, oh, things are great, wonderful, just gonna go to the moon and keep going up. Nothing's ever gonna be bad ever again. As opposed to shocks, which is, oh, the market's freaking out. It got caught off guard with something. And so looking at the different markets, and still a little more positive here with emerging markets. And we've seen this over the last few years. Now it's worked out okay in 2025, where you have some of these other markets actually outperforming the US market overall. But there's other times, kind of like the small caps, where it seems like they're getting going a little bit here and then they stall and end up either declining or going sideways. And then you have the Asia Pacific. You take out Japan. Here's Japan itself, Europe, and then the US. So still looking pretty good here, 10.3% to the upside with a 2.7 decline. We're actually below that here in 2025. But this is just a forecast looking at things over the world. That's still looking good overall, at least based on the forecast. But I don't forecast. I just look at the evidence that we have right now. This is what was happening in Friday's session. You had all these options, whether they're calls or puts, but the trading for the S&P European style futures that actually stops on Thursday, but you don't get the final price until Friday. That's what makes those options kind of strange. But there's a lot of stuff going on here and a lot of jockeying around and probably a lot of adjustments because of the down week that we had. And then all employees, temporary help services still coming up a little bit above the red line here, where it's when we're concerned is when we drop below the red line. And typically that happens before we go into a recession, but it didn't happen that way this time. And then consensus forecast for real growth as opposed to fake growth. This just includes um, inflation in the overall comparison of things. So Goldman Sachs thinks it'll be 2.1%, 1.9 with the consensus. Of course, we also look every week in the weekly video at the Atlanta GDP now and the New York GDP figures, and they're usually much more optimistic. They're up around, well, at least the Atlanta one's up around 4%, and I'll be going over that in the weekend video. But we're still positive here. That's kind of the takeaway, at least on the forecast, is that we're not looking to necessarily go into a recession because if we have negative GDP and then we see employment really falling apart, then that's when we're hitting a recession. So even though these may not be really strong numbers, they're still positive nonetheless. Then the share of companies discussing AI on their earnings calls. Yeah, AI is the buzz. I teach English lessons online to Chinese children, and if I say AI, they all know what I'm talking about. They may not speak much English, but they can say the letter A and the letter I, and they know what it means. And this is where a lot of things are out, whether it's positive or negative, because it's been positive there for a long time. Now it's like AI bubble. We're worried about this. We're worried about that. And so that's what a lot of people are talking about on their earnings calls. College educated unemployment is starting to go up here. That's kind of a scary thought there. And then Barclays Equities Timing Indicator, Betty. All right, Betty Crocker. It fell below -7 for the first time going back to August. The index has returned an average of 6.6% over the following 42 days. So this is shorter term and posted a median gain of 5.1% with a 90% hit rate going back to 2015 when the Betty drops between -7 and -8. Okay, so this is trying to pick out some kind of a bottom that could be developing here, that things are getting a little extreme. And then narrow rally, this also, and we've been seeing this in a lot of our charts now for quite a while, that it's really a select few of stocks that are really driving the market. And if those stocks have difficult days, the stock market tends to have a difficult day. Then the Magnificent Seven, and then you have the Four Horsemen of the Apocalypse here. This was back in the late 90s, and these were all the buzzwords at this time. And some of these stocks you really don't hear about that much anymore. Cisco, they make routers. Of course, Microsoft, they're still a big player, Dell Computer and Intel, where AMD was the distant redheaded stepchild of the bunch. Now AMD has surpassed that, and Nvidia's gone even beyond that. So it's amazing how things have changed over time. Um, but this just shows they constantly are trying to compare what's happening now with what was happening in the late 90s and early 2000s when we had the dot-com boom and then bust. And so, yeah, there's some similarities here. So we'll just have to see. I see them as different because there's real earnings behind these companies. It's not all just hype. But there is hype when it comes to AI because there are newer companies, companies that haven't stood the test of time. And some of those companies may just skyrocket with their share price. Others may just float off into oblivion. All right, then the sales growth, this is still going up for the most part, and that because to make money, first you have to sell something. And so even though it's not really going up all that much, it's still positive nonetheless when they forecast things out. All right, and then this I found on X here, or Twitter. On Thursday, we saw just a huge spike in put volume because everyone thought, here we go, we're heading for the hills, we're going down. The perma bears were right after years of being wrong. Says the put volume on Thursday was the second largest ever. Historically, this has usually occurred near bottoms. and this person here from bar chart. They're all happy about that. And this just shows 1 day later, 2 days, 3 days, just takes it out more shorter term. And we do tend to be positive when we see this massive amount of put buying. Puts increase in value as the market goes down. I use puts in a couple of different ways, not only to hedge positions so that if we are wrong, I'm at break even, but we can also use puts as directional types of plays. And this past week, the past couple of weeks have been pretty good with the program that I have. We've had some puts really coming in nicely and some different put strategies that are implemented. All right, so the intraday chart just chopped all around to begin with, and then it looked like, uh-oh, we're going to break to the downside. Well, we came down, hung out around the unchanged level for a while, and then some positive comments came out from the Fed, which took us up here to the daily pivot, went above and below the daily pivot, got above it, topped out right around the 66.50 level here, and then we did see some late day selling going into the close. So even though it was a positive day, we were off of the highs in the session. And then not much of a change as things shut down for the weekend here. And then we are still drifting off. We haven't really seen much of a change here with the intraday growth to value chart here, where the bigger picture is that we've still been going up. But lately, as we work our way through November, this is in the shorter term, continuing to go down. And we didn't see much of an improvement with the growth to value ratio intraday chart for the S&P either. It ended up going down in Friday's session. So growth was up, but up a lot less than value. For the large caps, it was up less for the mid caps, even though it was pretty strong. Also up less for the small caps. So we're still trailing off here with our small cap growth to value end of day chart here. We're falling below the 50-day moving average. We're falling further below the 200-day moving average with mid cap growth to value and further below the 200-day moving average with the S&P growth to value. If Friday was a real strong day, this ratio would have went up, not continued to go down. And we're still coming down here. We actually declined. This has been a little bit more liberal as far as staying positive when we look at this growth to value ratio, but we're falling a little bit further down still inside of the rainbow. And we ticked up a little bit, but we're still below the 50-day moving average when we look at discretionary to staples and that ratio. Large cap growth still holding out above its 100-day moving average, but still below its 50, which is indicative of what we're seeing with a lot of the indexes currently. And even with the update on Friday, the value to tech ratio continues to go up. So that's more negative in the short term, but in the bigger picture, this ratio has been declining overall. So these are the kinds of signs we're waiting for to see. Is the market shifting back and looking more offensive? Not yet. And you'll see that as we show more growth to value ratios later on in the video. We are rolling over a little bit here with the ADX in the short term, but we're still above the moving average. The red line is coming down, but also on Friday, even with the update, the green line went down. And so this is still a negative strengthening trend, but it's still below 20, so it's not confirmed. Also rolling over here, but still above the moving average in the intermediate term, but negative with the red line above the green line. And we did pick up with volume on Friday. Not a surprise there because you had all this options squaring that was going on. And that could carry through into Monday too, because a lot of people were assigned things. Because options expiration is really Saturday. The last day you can trade is on Friday. And then on Saturday, they pair up everything and assign everything. And then that can carry over into Monday for people that want to buy or sell going into the next week. All right, and we're still leaning more negative here with our gamma exposure. We're starting to see a little bit of green to the upside now. We'd have to get above 67.17 for this to flip back positive, where we're at 66.03 to round that one up. We do have some support here at the 6,600 level. We're just a little bit above that, and we closed pretty much on that level, but a little bit up nonetheless. And then we do see some other support levels that we've lost here at 66.40 and 66.25. So this is still leaning much more negative, although just seeing green over here on the right-hand side is an improvement. Now, the stock charts also didn't update I usually go over this for Friday's video. These are individual investors. They're still leaning more bearish than bullish. We have the red line above the white line. And then this shows the spread between the two. And even though it's coming up just a little bit here, they're still net bearish overall. And then they're still net bearish overall when we look at the 8-week moving average of how they've been feeling about things. We're still seeing a pickup in fear with the Ulster Index, and we decline, but we're still well above 20 with the VIX. And when we're above 20, that's when we tend to see negative annualized returns, thanks to the research done by Tom Bally at stockcharts.com and earningsbeats.com. And we're coming down a little bit with the VIX of the VIX. It slowed down a bit on Friday, but we're still well above the moving average with both the bar chart and line chart. And we did decrease here. A little bit of fear came out of this particular fear gauge, and we declined with this other fear gauge. So some fear came out, and we're seeing confirmation there. We did see a drop off here with the daily equity put call ratio chart, and we're starting to come back down with the 5-day chart after this was really going up pretty quickly here. But we're still going up with the 10-day chart, so it takes a little bit longer for that to see any more change in the overall direction. Now, again, as I've been pointing out, bigger picture with the risk on to risk off ratio, we're still positive, but we have been pulling back and we continue to decline even in Friday's session. And we're continuing to drop off when we look at the ratio between momentum stocks and the S&P. That's turning more negative still, and that declined. And we're seeing a little bit of a tick up above the band here with volatility risk premium, but it's not really spiking to a high level, at least yet. And a little bit of a turn up here with the advanced decline line. Shorter term, we've been seeing some weakness. Bigger picture, we are still positive. And we did bounce back up, but we're still negative with the short and intermediate term advanced decline ratio. Ticked up a little bit here with the advanced decline oscillator, but we're still below zero. Turning back up since we saw a bit of an expansion of new highs, really no new lows. So the 5-day is trying to turn up, but it's not quite back above its moving average. And we're starting to level off here with the 10-day moving average of the new highs and new lows. We're still negative here. We're below this red line with accumulation distribution. That's negative longer term. We did come up shorter term with the boom indicator, but we haven't quite crossed back above the moving average. And we're continuing to decline here with the Chaikin money flow, even though the histogram bounced up just a little bit, being less negative. We're still declining here with the Chaikin oscillator. So our three smart money indicators continue to be negative. We're negative with the vortex, which is kind of strange. With the big down day on Thursday, the red line came down. Then we had an up day on Friday, and the red line went up. That it calculates things a bit differently here, but we're still negative with the red line above the green line. And we did improve with our shorter term look at the advanced decline line studies, but we're still below the moving averages with all the indexes. And we improved here with those stocks in the S&P above their 20-period moving averages, but we're still below 50. So it's treating this still as negative. A little bit of an improvement, but still negative with the 50-period moving average study, 100 moving average study. And we almost came down to 50 here with the 200 moving average study, but we did bounce up. This one never has dropped below 50, so it is, at least recently, maintaining more of a positive stance. So we're coming back up here. It's really hard to see this because now we have the pivot points for December starting to come in to the picture, and we were above average with volume. So we did improve. We were really going down with the 20, 50, and even 200-day moving averages. They bounced here. And this is calculated on the S&P itself. No longer extreme with the Stochk RSI. The Williams percent are just barely coming out of being extreme. We improved with the CCI charts, but we're still extreme with the CCI 14 and the CCI 20, and bouncing back up above the moving average with the short-term stochastic, trying to turn up, but still extreme negative in the intermediate short term, or we're still declining below the midpoint. So that's still negative with the long short-term stochastic. And we did bounce up off of this Keltner band here with the force index. And we still have a ways to go to get back to this 10, 20, and 30 period moving average here. We've got a ways to go just to get back up to those lines. And we're still seeing more weakness here with the short-term trend. That really didn't improve on Friday. The green line and the blue line continued to decline. We're still below the 20-period simple and exponential moving averages. Now, this is that volume-weighted anchored moving average that I've been talking about. We broke through the shorter-term one, and that had held for a couple of days, and we came down. But this other one that's kind of a mustard color here, that level is still holding, and that goes back really when we started to break out earlier last spring. So this is still holding up for right now. And we closed above this level in Friday's session. And we're still just barely in the -2 channel with the standard deviations chart. It improved, but it didn't get back up to the -1 channel. And then we are improving, but still negative with the balance of power. And we're still on a full no-go here with the go-no-go system. We're still hanging out closer to the lowest low value on this chart. And the TTM squeeze starting to get a little bit extreme here. When it goes above -150, that's when we're extreme. We're at now 153.57, so a little bit over the 150 level. And we're still seeing speed really picking up here with the standard deviations chart. Still negative with the ease of movement. It actually declined even though we had an up day. And we're below zero and declining with the Arun. That's turned this more negative with the oscillator here. And we did improve with the S&P McClellan oscillator, but we're still below zero. And so we're continuing to decline with the summation index based on price and volume. Also improve with the NYSE McClellan oscillator, but still below zero. So we're still declining with the summation index based on price and volume for the NYSE. Now, this is where we are seeing a bit of an improvement. We did turn up with the Swollen Trading Oscillator based on price, starting to turn back up based on volume. So that could be a positive development there. We're still declining from a momentum basis, though, with the PMO going down, price and volume continue to decline. We did improve with the PMOs that are rising, and we're climbing back above 50. So that's one of the internal measures that actually showed a little bit of strength. We're turning back up with the buy signals, but we're still below 50, and we're still declining with the PMOs that are above zero. Still negative with the parabolic SAR, and we're still negative with the slope oscillator. We're down below this red line, which could mean that we're getting extreme negative, and we're continuing to decline with the MACD. We're below the midpoint and continuing to go down. So short, intermediate, and long-term oscillators are still negative, as is the Copic curve momentum oscillator. And we, on an update, we actually ticked down here a bit with the Sean trend meter. We're below 50 and declining with the money flow. We ticked up, but we're still below 50 with the ultimate oscillator. Still above the moving average. This is longer term positive here, and with the unbalanced volume. And we're no longer extreme with the short term RSI. We did bounce up, but we're below 50. We did turn up with the intermediate term, but we're also still below 50. And we're, after being negative for a number of days, we've switched over to neutral with the Elder's Impulse system for the S&P. We're still declining here. And even though we had an up day, we were down 2.5% with the bullish percent index. It actually went up a bit on Thursday, but then on Friday with the update, it ended up going down, but it closed off of its low here. And we're still declining below 50 with the NYSE bullish percent index, and we're coming back down. And if we get down to the 30 level, that's when the NASDAQ 100 bullish percent index is extreme. We're still above that level. And the intermediate term trend based on 50 periods also showing some vulnerability here as we've been underneath both lines, and both lines are starting to go down, and we're below the 50 period simple and exponential moving averages. So that's still negative for the intermediate term, and we're still holding as support here with the 100-day moving averages. So that's the next level that we're watching if we start to see some more weakness in the upcoming week. Now, this is a different look at it here. This is also the 100-day moving average. I think I got this off of Twitter or X, and it just shows, okay, they're trying to take some time into account here. They're using 80 bars here, which is a cycle that they're using, and we're getting really close to that mark again. And so they're thinking, well, maybe there's a chance here that when we hit this 80 days, these 79 bars goes to 80, maybe that will mark some kind of a bottom. We don't know, but I look at these things, I find them interesting, they're good to know, but I don't base decisions on charts like this. And then we're still below the 20s and 50s, and we're seeing the 20s begin to roll over now and start to come down to the 50s. And we're still far away underneath the 20 period moving average from the boom indicator, still below the midpoint, but not extreme with the 50. And we did tick up just a little bit here. We're still above the midpoint with the 200 moving average steady. And we're still inside the cloud here with the Ichimoku cloud. So far, this cloud has been acting as support as well. And so we were down 1.95% for the week, and we are seeing a little bit of a threat here to this overall bar pattern with the higher highs and higher lows. We did make a bit of a lower low, especially after Thursday, and that's kind of ruining the pattern than what we've seen. Doesn't mean it's the end of the world. We just want to make note of this. We're still above this R1 pivot point, which is support that we might hit if we see more weakness. All right, so still looking more negative with the hike in Ashy, or red and pointing down with the Kigi chart. That's negative. We're negative with the Renko chart. We're negative with the three-line break. So none of our trending charts have actually switched over to positive. And longer term, we did come back above the midpoint with the 150 moving average study. We bounced just a little bit above the midpoint here with the 200 moving average study. And now we have another one of these that we can keep an eye on, which could end up being quite positive if it plays out. Now, this is after Thursday. There's a 1 day lag, kind of like with the Hindenburg chart that we have here. We had an extreme negative reading after Thursday, and that was November 20th. Now, what we need to have is between now and December 5th, we need to bust all the way up above this red line. If that happens, that would be a confirmed swag NYSE breadth thrust. And that could be quite positive for the market. We don't know if it's going to play out that way. We had another extreme reading on October 10th. It never made it back up to the red line. But now we're just watching. This is not a signal. This is now we're watching to see how this will unfold. And then we did have a Zwag NYC breadth thrust coming up out of the lows in April. And then that was positive after that. So we'll see if this turns into something. And so we're still negative in the short term across all the indexes. Again, I still have us as negative with the S&P. We're also negative with the mid caps. And we're still negative in the short term with bonds, and we're down to looking negative. This is a change with commodities in the short term, but the dollar is still in an uptrend in the short and intermediate term. So all of the indexes ended up being higher. Now, utilities were virtually unchanged. And materials, which has just been getting pounded lately, they saw some favor in Friday's session. Healthcare, a defensive area, but then we see discretionary and communication. Those are more growth areas. They improved, but they're not changing the bigger picture of the short term, but they're still positive in the bigger picture in the long term. And then a bit of a bounce with real estate. And then we had tech down here that really didn't do all that well. And so saw some nice little blue here. A lot of alerts were triggered in Friday's session. Right after the open, we had a bearish MACD crossover with energy. And then we had the NASDAQ 22.2. Then apparently at about the same time, it was 22.1. Then we got up to 22.5, 4, 3, 2, 1. It was when this is pulling back, got down to 22,000, 21.9, and we busted back up to 22.3, and we the close getting into 22.4 and then ultimately 22.5. So a lot of bouncing in the Nasdaq. And then with the industrial sector setting a BPI cross below 30, again, that's a little more negative there. And then Canada had a pretty good day on Friday, and then healthcare set another new 52-week high. This has been the best performing sector in November, and that's also defensive. And so that's a little bit of a concern to us there. Energy had the BPI cross above 50, even though earlier in the day it had a bearish MACD crossover. That's one kind of technical event. Later in the day it had a BPI cross above 50, which is a positive technical event. The S&P did get back above 6,600 as well, and then it went below it again. We closed just a little bit above it. And then so the big stocks here, Microsoft, Nvidia. Nvidia continues to go down where Apple was up. You had Broadcom and Oracle. Oracle got spanked pretty hard, even in Friday's session. So then communication did better because both Google stocks were up. Discretionary did okay because Tesla was down just a mere 1%. We're used to seeing 4, 5, 6% moves here where Amazon was up, and then a lot of green in the rest of discretionary. You can see all the green here in healthcare. That's really been coming on strong, seeing a bit of improvement with the financials as well. And then Staples didn't do all that well. There's a lot of green here, but Walmart didn't really have a very good day. So the Dow is still below its 50-day moving average currently, but it's in a longer term uptrend. We've gone from negative to neutral with the diamonds, and we're still below the 50-day moving average with the Nasdaq, but we switched over to neutral with the Elder's Impulse system. Bit of a bounce here with the Nasdaq 100, but the momentum continues to be negative, and we've gone over to neutral with the Elder's Impulse system for the Nasdaq 100, and up over 3% with the S&P 600 small caps, but not even back up to this pivot point yet. So we're gonna again need to see more than just one day of solid moves there. And we did bounce up, but we really haven't broken this series of lower highs and lower hoes. Okay, the Russell 2000 small caps, lower lows here, even though it had a good day on Friday. And we're neutral with the small caps, with the Elders Impulse system. And mid caps still below their 50-day moving average. They did come back above this pivot point here, which is the dashed line. And we're neutral with the mid caps. And we're still below the 50-day moving average with the Wilshire as well as the total US stock ETF. Still below the 50 with the FANG index. So Apple was up almost 2%. It's been holding up a little bit better than some of the other ones. We're still in a downtrend here with Bitcoin, and I have that other chart to show later on. Amazon still dealing with its 200-day moving average, but so far it's above that. And we're just a little bit above the moving average with Microsoft. It was still down on Friday. And we are looking pretty good. Google's been one of the stronger stocks lately, just below the 300 level. And then Meta still dealing with being under its 200-day moving average, even though it was up 0.87%. Nvidia still continues to drop further below its 50-day moving average. Tesla also below its 50-day moving average. And Netflix, it was down again. And we're in danger of seeing a death cross here. The last time we saw this was in late 2022 when we saw a golden cross. This would be the first death cross since really seeing a solid uptrend. And then the Dow Jones Semiconductors still underneath their 50-day moving average. And they were still down a little bit on Friday. And we were up a little bit here with the SMH semiconductor ETF, but still below the 50-day moving average. This is a weekly chart. We're coming down. We're actually dropping below the 100 level when we measure the distance from the 200-day moving average on the Dow Jones Semiconductor Index. But even with Friday's advance, the staples to tech ratio, that's still going up, and that's more defensive. And we're seeing Bitcoin, as I showed earlier, that's the red line. It's just can't seem to stop going down, at least for right now. And then there's still a really high correlation between the Nasdaq 100 and Bitcoin. That's why I started showing this chart. And oil continues to drop. We're getting into the high 57s now. We're still above 100 with the US dollar index, and we're coming down, dropping below the 50-day move. Excuse me, this is the, yeah, 50-day moving average with the 10-year yield. I'm used to it being red. Okay, and here we're still above the 50-day moving average based on price with the 10-year. And we didn't really see much of an improvement. They turned up, but nothing really switched with our different growth to value ratios. Still going down with the Qs to S&P, turned up, but below a declining moving average with discretionary to the S&P, still declining when we compare large cap growth to value. So the large caps, mid caps, and small caps didn't really improve that much with their growth to value ratios on Friday. And we're still going up with the staples to S&P ratio. And that's a market getting more defensive in the short term. Longer term, we've still been in a pretty significant decline, which is positive for the S&P. And then here's the latest chart. We don't have another new spike with the Hindenburg Omen, but we had the initial spike on October 10th, and then we've seen a series of confirmation spikes after that. And that's negative when you look back right before the COVID crash, right at the end of 2021. So what's the outlook for Monday? We're still negative in the short and intermediate term. Long term, we are positive. I don't know. After looking at those calendars, I don't know what's coming out this week. And then you've got the holiday thrown in there as well. And then anything geopolitical that may end up happening as well. And here, I didn't even update this. Now, seasonality, when we look at November 24th, it is positive across the board. Now, we're coming into the week after options expiration. Now, the week before, we're typically positive, or the week of, I should say, the week of options expiration. That's been up 59% of the time, down 41. Well, we had one of the 41 percenters this time. Are we going to flip-flop that? Because the week after tends to be up. And here, we still see a pretty solid move here. So we do have some positive seasonality coming into the picture. And then here is what we're looking at for Monday. We not really much in the way of post-election years with the green dash line here. Just kind of chop along as we start to finish out the rest of November. And then and I have a number of charts here that show that we should be in a period of positive seasonality now, including this chart, this chart, this chart, this chart, and this chart. So we're still waiting to see if that's going to happen. And then this chart shows different ways of calculating things that happen in November, and that it tends to be the strongest month of the year. But so far, that just has not developed. So the warning signs, our three smart money indicators are still negative. Our shorter term growth to value and discretionary to staples ratios are still negative. The parabolic SAR is negative, as is the money flow and ultimate oscillator. The momentum is negative. And we improved, but we're still negative with the McClellan oscillator and summation index for the S&P and NYSE. Ease of movement actually declined on an up day, and the bullish percent indexes for the S&P, NYSE, and Nasdaq 100 continue to be negative, as does the vortex. And the momentum for the Nasdaq 100 is still negative, and we've got this Hindenburg omen lurking in the background, as I say there. All right. And then longer term, though, we're still hanging on to uptrends with growth to value and discretionary to staples. Swell and trading oscillator, that's one change. That's something that's actually showing a bit of an improvement. And then the financial sector is still in an uptrend, but still underperforming the S&P. I didn't show that chart in this video because I'm going to be going over those again in the weekend videos. And then I'll also be showing this in some of the weekend videos with the special K long-term oscillator. Here are the pivot points for Monday's session. So our conclusion really didn't change anything here. Negative in the short and intermediate term because of the moving averages and prices below both. We're still not really seeing much improvement here, and we are trending now, but in the long term, we still continue to be positive. Thank you. Have a wonderful weekend, and I will talk to you in the next video.